Welcome to this session. Markets were never as interesting as the current times. We are living in an era where everyone from a teenager to an auto rickshaw driver, everyone is discussing markets, and market क्या लगता है has been conversation at dinner tables of late. Mutual fund सही has gone a long way in attracting investors to the disciplined SIP route. The surge of discount broking firms, unprecedented gains in stock markets have attracted a lot of investors in the market of late, and the demat accounts have already reached a 10 crore mark. It's probably one of the most interesting times in market in my entire career. Welcome, Neil.
Thank you, Neil.
We have with us Neil to help us decode the bull versus bear market conundrum. And the most important question that plays on everybody's mind, how do we build a profitable portfolio? So Neil, to start with, as I discussed, we've seen some unprecedented gains in the market. From March 2020 lows to now, when central banks have just opened their tabs full throttle and market rallied despite the lockdown, and now when they are having a hawkish stance, things are looking uncertain. As a fund house, how are you navigating the current times?
Yeah, so thanks Ami for that question. So in fact, I'll go and say that right now is very normal times. The last 2 years were quite abnormal. For one is that in human history, we've never seen negative interest rate or zero interest rates. Okay? There was a time during COVID that oil prices went down below zero. So manufacturers were telling you they were paying you money to take your oil. We've never seen such a scenario ever. In fact, today I'm actually quite happy that we are back to normal time, because interest rates are supposed to be positive. In the mid single digits is actually quite low even historically, because India has seen 14, 15, 17% interest rates, so has the US. So I think we're pretty in a normal state right now. Obviously, the biggest concern right now is inflation. Inflation because of the war, energy prices are a big concern. We know what's happening in Russia, and Europe is going to see a very cold winter because of the energy prices, which are fueling inflation. At the same time, because it's fueling inflation, interest rates are going up. So let me just go a little back in history, 2 years back, at what happened actually during COVID. What did governments and central banks world over do? COVID hit us. The government told us, guys, all of you stay at home. Government and the central bank said that listen, they were going to put some money in people's account. So you are going to go hungry, and you will you won't. In at least the foreign country, that the cold won't kill you. You just survive this period. Okay, so I'll give you money. I'll keep the interest rates really low, so you can able to buy things. So demand is not affected, and that went on for a year and a half. After that, when we started opening up, obviously the demand surged. We've all heard the things of revenge spending and all that stuff, right? So people went mad. They started spending crazy. That obviously led to more and more inflation. At the same time, countries like China was still shut down. So there was supply chain bottleneck. So on one hand, demand was really strong, and on the other hand, supply was very short. So that really fueled the inflation. Then the war came, energy prices went this thing, went really up, and that has fueled inflation. So interest rates are going to go up. What we are looking at is that yes, interest rates will go up for some time. I think a year and a half. But I think governments have learned from their past mistake that you cannot just keep raising interest rates and affecting growth. So I think for the next 1.5 years, the markets are going to be very volatile. But if anyone has the capacity to stay for 5 or 7 years, there's great money to be made in the market. Also, the fact that returns from the markets are lumpy, it's never linear. Linear means that they will give you 6% year on year. Markets, people say, "Acha, 15% to deta hai, 15%." But that 15% comes over a time. There will be 4 years like you make 0%. Then the 5th year we make 50, 60% and take care of it. So that long-term thinking is very necessary. If you have 5 or 7 years to hold on, I think we're well poised to make great returns from the markets.
Okay, that's insightful. At the same time, as I said, around demat accounts have crossed the 10 crore mark. But then 1/3 of this 1 crore figure, Those accounts have been opened in the last 1 year. And these investors have entered the market when markets are relatively expensive. At the same time, we also carry high hopes looking at the returns behind them. The traditional option FDs are not giving enough returns to even beat inflation. What should be the strategy for this new retail investor entering the market? Go directly in the market? Go the mutual fund route? What should be the option?
Yeah, so first of all, investing is a full-time job, right? I mean, we do it at our end and we know that it's a full-time job. People who think that, I'll get a tip here and there or go to Twitter and see what people are talking about and buy stock, that's a recipe for disaster. I don't think that's not a strategy you can use. So if you're going directly, if you are willing to give it time, if you've got a research capability, you've got tools, you've got patience, you've got time in hand, then surely do it by yourself. Just make sure that you don't fall into the trap of buying things because you've heard, ye acha lagta hai, or somebody said buy this stock, I think this thing will go, will double, triple or whatever it is. That never really happens. Yeah, I mean, you can get lucky once or twice, but I have seen over the last 15 years that most people lose money. People will only talk about stocks when they are making money. Let's put it this way. So they will make money in one stock and they will go to a cocktail party and say, "Maine to itna banaya." But they will not talk about the nine stock that they have currently got to zero. And that is the fact. People will only talk about what they have made, but actually people have lost more money than they have made. So one thing is that yes, go directly if you have all these research capability and you got a mindset for investing, but it is a full-time job. It's not 20 minutes I spend and I will buy something. That doesn't happen. The other route is obviously the mutual fund route where you give your money to a professional to manage your money. Again, the mistake people make here also is that they will look at any fintech platform and the fintech will say that last 6 months or 1 year this fund has done well and they will buy it based on last 6 months or 1 year. I think that's a mistake. Don't look at the last 6 months, 1 year and think that in the future this fund is also going to do well or any of that. I think a little bit of homework is really necessary to figure out what this fund house is doing or read about the literature they have put out. And we've got a great tool right now, it's called the SIP, Systematic Investment Plan. I think that's a great way to invest in the market is because you don't time the market. I mean, if the markets are down, you will get more units for the same money. If the markets are high, you get less units for the same money. So you don't need to think about it, just let your money compound and just do a SIP. I think that's a great way to enter the market.
I agree completely. I think SIP route to start with would be the thing for any wise investor. This brings us to the topic we are all here for. How does one build a profitable portfolio? What are the 5 key lessons you have learned during your journey of decades?
Yeah, so I think some of the lessons that I've learned over my journey, and I think they are kind of evergreen, and these are things that we follow, I follow personally, and we follow in our own fund. So one is the law of the farm. You cannot read today and you cannot sow something today and read tomorrow. Just like a seed needs to go to various seasons, a lot of time is needed, nurturing need for it to become a full-grown tree. Similarly, investments are similarly like that. I mean, give it some time, have a long-term thinking. Over time, markets have really done well. In the middle, there will be ups and downs, and markets are inherently volatile, like I said. It's lumpy returns. I mean, there will be 3 years that will frustrate you. Market ne kuch nahi kiya, I'm losing money. And at the time people sell and then after the market takes off. So have patience. Markets have always rewarded about 16-17% kind of returns has been there in the market, but you have to give it time. Just like a tree grows into a seed grows into a full-grown tree. I think if you have a long-term horizon, money is there to be made. If you have a long-term horizon, then what happens is that you don't work for money, money works for you. And by that what I mean is that you don't need to work for money in the sense that your job is obviously important. But if you start investing that money slowly and steadily over time, that money will compound really well. And even it will make money when you are also sleeping. So when you are a little older or approaching retirement age, that money will be working for you. So you don't really need to really work for money. Thirdly, don't chase market fancies. Again, the famous saying is that chase a market fancy, you pay a fancy price. When the fancy ends, you're left with the fancy loss. And that's what's happening. That's what happened. That's the human psychology that we always love chasing the new. I mean, and it's happened since years. There was the tulip mania in 1600 to the crypto mania recently, and in between everything. So don't just chase new things at any valuation. I think that's a recipe for disaster. Sometimes whatever is neglected makes more sense to invest in. So that's third. Fourth is be greedy when others are fearful and fearful when others are greedy. Market is the only place where there's a sale nobody wants to buy. So when markets are down, nobody wants to buy it. They only want to buy it when the markets are going up. So I think don't follow the herd mentality. If everyone is buying at the time, it's okay. When everyone is selling it at the time, you need to buy. And lastly, investment is supposed to be boring. The minute it turns exciting, remember you're not investing, you're gambling your money away. So it's supposed to be very interesting. It's like looking at the grass grow. Looking at the grass grow is the most boring thing, but investment is supposed to be just like that. Is that you invest and you just wait and don't do too much. But if you do too many actions, you're probably going to lose. I mean, you're better off than betting on IPL or going to a casino. At least you'll have fun, you'll get a couple of drinks also while you're at it. And have fun doing that if you don't gamble. But investing is supposed to be boring. So
that was very insightful, Neil. And Neil, who are your investment gurus? Who do you really follow closely? What is your style of investing?
Yeah, so value investing is our style. Warren Buffett is obviously someone we look up to, admire. Peter Lynch is someone else. Again, my fund manager Rajiv Thakkar, he's been with us for 20 plus years. And my father, Mr. Parag, who started this company. So yeah, these four are my gurus.
A lot of things changed for all of us in the pandemic. We suddenly realized a lot of truths in life which we were not aware of. Be it minimalism, be it lack of materialistic things. We just had a lot of new awareness, so to say. Has pandemic changed any of your core thought processes on investing?
So let me tell you, somebody asked Jeff Bezos this question recently or a little while back. I don't know exactly where that. What is going to change and how are you looking at your business? How are you looking at Amazon? What will happen to Amazon? What are you looking at? Things are going to change and how you positioning Amazon towards these changes? So he's like, I'm not interested in what will change, and I probably don't know what will change. But I'm more interested in things that will not change. And he said, let me tell you what will not change in the future. Today, my customers want low prices. They will always want low prices. Nobody is going to go to Amazon to look for the highest price, they're always going to look for the lower price. That was true 50 years back, that's true today, and even 100 years from now, the human psychology will be the same. We will want a bargain, we will want cheap prices. That's one. Secondly, the choice. If I have to give them enough choice to make it more viable, people want more choices. They don't want to come to Amazon and say, okay, give me less choice. They want more choices to see that what is actually what is good for them. So he's like, I have to make sure that 100 years from down the line also, I think people will want more choices. They will want less choices. And thirdly, today people want quicker delivery. Today if you order Swiggy or something, you're like, 4 घंटे बाद आ जा. You're hungry right now, you want food right now. So quick delivery is going to be there. That's not going to change. He said, I am focused on low cost, giving more variety, and I'm focused on giving quick variety. These things are not going to change. This is my focus. So I think even in investing, there are things that don't change, and that's what we are focused on. In fact, the pandemic made this stronger that these things, these principles of investing are evergreen. They're not going to change. So our focus is on what is not going to change. So what is not going to change? Buy low, sell high. People are never going to make money by selling, buying high and selling low. So obviously look for a bargain, always look for a bargain. Fundamentals are important, so you look at fundamentally strong company. Secondly, a chore management would have stolen from you 50 years back, they steal from you today, they steal from you 50 years from now. So look at clean management, management that you want to partner with or that you want to give them your money for investing. third is over-leveraged companies will bound to lose compared to a cash-rich company. In the pandemic, we saw if a company is cash-rich, they could give dividends, they could actually make acquisitions, and actually they grew very well if you had cash-rich. Over-leveraged companies actually a lot of their sums. So our focus is on things that will not change more than things that will change.
Great. Crypto as an asset class has emerged, and obviously as people have also burned their fingers lately in that way. It's one of those asset class, understand or not, people have been deploying funds left, right and center, particularly the Gen Z. What are your thoughts on crypto as an asset class?
So, as an investor, or if I want to put my money somewhere, the most important thing is understanding what I am investing in. I think that's the main thing. If somebody understands crypto and wants to put money and understand the risk of crypto, well and good, put it there. But I don't think people do understand that. I think, at least for me, I have not understood crypto as such, or cryptocurrencies. I mean, we all understand that blockchain is going to be useful in the future. We don't know how useful or whatever it is, but there are use cases to it. But crypto trading on cryptocurrency, I think that is something that I have never understood, because me and you sitting here in a crypto asset. So I mean, what is the underlying as such? So I don't understand that, and I don't understand the things that I don't understand. I mean, I don't invest in things that I don't understand, and that's pretty much what it is. Even for stocks, there are certain stocks that we don't understand what the company is doing, so we stay out of it. There are other places to invest and make money. So yeah, avoid those things that you don't understand.
Absolutely, makes complete sense. Anil, when I talk to 20-something kids in my family, these are the people who just started their careers, and they have seen the market going only in one direction. When I ask them what do they do with their excess money, it's all about direct stocks. They don't understand mutual funds, or they don't want to understand other options like fixed deposits, gold. For them, it's all about stocks, particularly small cap stocks. And some of them obviously are getting it wrong at some point. What is your one message to this young investors who really want to make it big in the stock market?
So when I started my journey in the stock market, my father told me one thing. He's like, I hope you lose money, and I hope you lose it fast. Okay? Because only once you lose money will you know the value of money. Unfortunately or fortunately, we not had a bear market in 15 years. So you're talking about 20-year-old kids. The last bear market was during the financial crisis. These guys were in diapers at that time, right? I mean, so I think anyone who's less than 40 years of age has not seen a bear market. So one thing is that they need to lose money. It's like something like saying that okay, somebody is at a risk of a heart attack, but he's drinking, he's eating unhealthy, he's not exercising, and you pay how much gamble them. Some people will listen to you, some people say that no, I'm doing nothing's happening to me. I will keep doing what I am doing. But the day they have a heart attack and they survive, the next day they will eat healthy. They will go exercising, they stop drinking, they stop smoking. So until the experience is there, until they don't lose money, unfortunately, most people are not going to understand. They'll keep partying until the party stops, the music stops, right? I mean, and unfortunately that is the thing, until you get a hard slap on your face, things will probably not change for a lot of people, So experience is important, experience of losing money is important, and only when you lose money will you really know the value of money.
Very well said, very well said that. Mutual fund has gone a long way, in attracting investors to mutual funds and getting them into the habit of investing. What more do you think can the industry do to attract investors, considering that the penetration is less than 10% in a country as huge as ours?
So that's a very interesting question, and I'm not that disappointed about the numbers. I tell you why. Is because the stock markets are about 40 years old, but the actual equity culture only started 7 to 8 years back. And when did it start? When demonetization happened. Before demonetization, there was cash rich. People would invest in real estate, gold mainly. Once demonetization happens, a lot of bank accounts were opened. Most of people came into the formal sector, from the informal to the formal sector. They had PAN cards, bank accounts, and they are only rising right now. And you have seen this growth only in the last 5 years, which has been significant after demonetization. So if you would see the numbers 5 or 6 years back, the mutual fund industry was managing about 30 lakh crore assets. Today it's close to 40 lakh crore assets. So I think the growth has been pretty good. So I'm not disappointed about the growth. I think as more and more people are going to come into the formal economy, they will get into financial assets, mutual fund, direct stocks, productive assets will go up, and they'll be less dependent on, say, gold imports or paying cash for real estate as such. So again, what we as an industry have to concentrate on is communication. I think communication and education. I think a lot of people still don't get it. A lot of people also understand that stock market is just gambling away. It's like, okay, sit at home, now you do everything on it's like a game. So that education has to be there, that communication has to get stronger from us. But other than that, I'm very confident that over time, this will convert into the numbers that we're talking about.
One last question. I know we are a minute or two over time, but since this is an HR summit, I think I must ask you this. Your fund house, I've been tracking the fund house for many, many years, and I think it is one of the places which has the lowest attrition rates. You had your core team with you almost forever now. What is the secret out there?
One is, so when we were small and we couldn't compete with market salaries, so we were competing with HDFC, ICS, the bigger guys. I mean, small fund house like us who had no backing, corporate backing, bank backing or anything, how do you want to do it? So one thing we did was, we started sharing 50% of our operating profit with our employees. Like, as the company, however well the company does, 50% of profits will be shared with you. Again, as we grew, ESOPs were a big deal. We started giving ESOPs, and people have realized that the ESOPs can have a great value. So a lot of people who understand ESOPs, and those ESOPs mature in like the next 10 years, at least you know that they can be for the next 10 years. So financial that was there. Also the culture that we bring, work-life balance culture. We want everyone to go home at 5 o'clock. If you're going to spend most of your time in the office, you have to be also, if you're happy in the office, you have to be happy at home and the other way around. So don't spend too much time at office, number one, right? I mean, spend more time with your family. I think some of these things I represent us.
Thank you, Neil. Thank you, audience. It's been a very engaging